Good morning, and welcome to the Energy Perspectives Group webinar hosted by InPlay Oil. This event is being recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here is Dan Steffens, who will introduce today's speaker.
Good morning, everybody. Sorry we were a couple minutes late in starting, having a little technical difficulties. We've got a big thunderstorm going on here down in Houston right now. But welcome to the webinar. It's being hosted by InPlay Oil, one of my top picks in our small cap growth portfolio. InPlay Oil is a Canadian junior upstream oil and gas company that we've been following for probably over 10 years now. The company survived the sharp decline in oil prices during the 2020 pandemic by swiftly pulling back on their capital expenditures. And then while oil and gas prices were still rebounding in late 2020 and 2021, InPlay was able to close several strategic acquisitions that have them in great shape today, adding a lot of running room. And you all know that I love running room. These transformative acquisitions, the big transformative acquisition was the Prairie Storm deal that closed on November 30th of 2021. It put InPlay Oil on a path to production growth from 5,800 BOE per day in 2021 to more than 9,600 BOE per day by the fourth quarter of 2022. Their production split is 41% light oil, 43% natural gas, and 16% NGLs. The company's operating cash flow jumped from $44.1 million in 2021 to $127.5 million in 2022. That's $1.47 Canadian per share. So the stock is just trading for about 2 times last year's operating cash flow. So a lot of upside, I think, for us. In the second quarter of 2023, InPlay's production pulled back to about 8,500 BOE due to the Canadian wildfires, shut-ins that you all heard about, other weather-related issues, some midstream issues. The wildfire-related shut-ins came back online in Q3, and their summer drilling program is generating steady production growth. The production increased 47% in 2021, another 58% in 2022 to 9,105 BOE per day. And the company is now on pace to exit 2023 at about 10,500 BOE per day per my forecast. And the company has more production growth ahead because of a deep inventory of low-risk, high-rate development drilling locations. So joining me today is the company's founder, Douglas Bartoli. Doug is the company's president and CEO. He founded InPlay Oil in November 2012. Prior to forming InPlay Oil, he was the president and CEO of Vero Energy, Inc., a public oil and gas company from September 2005 to 2012, and then founded InPlay shortly after that. He also previously served as the vice president of operations of True Energy and held management and engineering roles with Husky Energy, Renaissance Energy, and Pan Canadian Petroleum. Before I turn over to Doug, I just want to say a few words about yesterday's dip in oil price. You know, oil dropped, pulled back to 88. I think the only thing that justified that is the strong U.S. dollar, because fundamentally there's been no big change. Demand for oil exceeds supply, and I see much higher oil prices. So during the webinar today, if you have questions, please type them into the chat box, and we will answer them after the presentation. With that, I will now turn it over to Doug Bartoli for an update on InPlay Oil. So go ahead, Doug.
Okay. Well, it's good to be chatting with you and your group again here, Dan. We're a little behind, so I'm going to get right down into it. But like you said, I mean, we are in such a great financial position. It pretty much allows us to get through thick or thin, and that's one of the best pieces that I know is going on right now. And you're right with the price of oil. I mean, $1 uptick, $1 downtick, a few dollars, and the volatility. There's just so much noise out there. I don't think it's a demand issue or anything at this point in time. In the meantime, it doesn't really change the multi-year oil bull thesis that we see here. But anyway, our strategy is to continue to show top-tier production, per share growth, strong funds flow generation, conservative leverage ratios, and increasing our returns to the shareholders. We have an 8-year track record of delivering top-tier per share growth through multiple ups and down cycles. You know, in 22, like you said, it was just a great year. I mean, it just set us up for the position we are today. Record fund, adjusted funds flow of 130 million, free funds flow of 53. Outside of paying, starting our dividend in November of last year and paying, buying a few shares, the majority of that went to pay down debt and put us in this great position. So, you know, for this year, we'll average 91 to 9,500 BUEs a day. You know, it has been an operational downtime year. We'll talk about that on another slide, I guess, but we'll drill 16, 17 net horizontal wells. I mean, the reserves are still just strong, sustainable, large RLI there. As far as shares outstanding, we've got about 89.5 million basic, 93.7 million fully diluted. You know, our market cap at 275 Canadian per share is 246 million. Debt at the end of Q2 put us at 288 million. That monthly dividend is 6.5% at 275 yield, 1.5 cents a month or 18 cents a year. And I mean, again, with our balance sheet where we sit, easily sustainable down to $55 WTI. You can see the liquidity there on the Toronto's exchanges and the OTCQX. It's been hovering in that mid 300,000 shares a day range. So pretty good liquidity for a company our size, and good ownership from the employees and directors. And then plus a large insider shareholder, totaling, you know, that's getting up into the 30% range, the insiders and the employees and directors. Sorry, we ended our second quarter with net debt of about 42 million, low capital quarter, so about 46 billion in bank debt. So a little working capital deficit there, but that'll start erasing by the time the year's over. On a solid revolving credit facility of about $110 million. I'm not going to spend a lot of time here. We've talked about this a few times. All the information's on our website in the back of the presentation. I mean, one change I want to talk about is we just recently hired Kevin Leonard as Vice President of Business and Corporate Development. He's got over 18 years in the investment banking business, predominantly in the energy sector. Gordon Reese, who's been with us from the beginning, has retired, and we replaced him with, you know, someone that very, very strong on the corporate and business side. So other than that, everything's been very, very consistent with our management team and our board of directors. The other piece, I guess, Craig Galanowski, he's the chairman of the board. He's also indirectly his company or his private equity firm is in charge of that 22.5%. And those guys have been with us through thick and thin, right from the beginning in 2014, adding more shares in 2016 when we went public, and they haven't sold any. This is always my favorite slide. I mean, this is our track record. And when you take a look at it, you know, track record's a pretty good indication of what you do going forward. That top left corner is our production growth. The light green in the columns being oil and natural gas liquids, the orange being natural gas. Those blue boxes represent production per share growth. And I mean, when you grow production and reserves per share on a continual basis, you will make money for your shareholders, as long as it's not all through debt and you don't blow things up. And in fact, our debt has just been decreasing, so the exact opposite. But great growth since we went public over that time frame. So annual growth of over 58%. Our reserves on the top right, that's the same. Like, you know, we were growing between 5 and 12%, pretty much organically from when we went public in 16. A nice little deal, tuck-in deal at the end of 2020. Had us really turning the year, the COVID year, in from a really poor year into a pretty good exit year. Added more reserves, added more production, but also started us on our next step of production and reserves per share growth into 21 and 22. Then, of course, in 21, we closed Prairie Storm, as Dan said, at the end of November, and you see another massive jump in production and reserves per share. How does that work financially? Like, you know, when you go in the bottom left corner, adjusted funds flow, that's our key. That's you know, that's what pays for everything. That's what pays all the bills, and of course, this is after G&A, interest, and other royalty items, things like that, operating costs. But this allows us for our capital, our dividend, and everything else. But from 17, 18, 19, in a pretty tough environment, we kept growing our funds flow. And you can see the blue boxes were growing every year. 19 at 5,000 barrels, we did 32.2 million. Just wanted to survive in 2020, and that we did. 21, 5,750 BOEs a day. We did just under 50 million of funds flow and about 70 cents per share, all the way up to 130 million and closer to $1.50 per share in 2022. And of course, 23 lower commodity year, so a little bit lower funds flow estimated. But we're also only using $80 WTI from August till the end of the year, and currently it's significantly higher than that. And then finally, you look at the bottom right, like the leverage. It's done nothing but come down since we went public. So 17, 1.9 times debt to EBITDA, all the way to 1.6 and 19. Industry used to always run in those type of leverage ratios, and it's changed. But we've really been able to change it. 1.5 times in 21, and then down to this 0.2, 0.3 times here in 22 and 23. So really low leverage. As I mentioned, best operating financial position I've ever been in any company I've been involved with. And it just allows us to get through thick or thin. I'm not going to spend a lot of time on the reserves. I mean, it's a year old. I mean, the key to it is our proved developed producing, our just base blowdown case is over $3 a share. So we're trading at a good deep value here when you're trading under that value as we sit today. Ultimately, I think in a reasonable market, you should start working your way into closer to a total proved category. Again, you know what? We're consistently adding producing barrels and adding reserves at a very efficient basis. In the top left corner, 2022, proved developed producing, finding development acquisition costs, so finding barrels of oil equivalent in the ground. We were number 3. But when you look at the 3-year average in the bottom left of proved developed producing, we're number 1 at finding our reserves for just over $10 a producing barrel, which is the blue columns there. Top right, total proved finding development acquisition costs. Same thing, number 3 in 2022. But our 3-year average, we were number 1 at, again, around $11 WTI. So really, really efficient adding reserves. As you can see, it also showed up very nicely in our increase in reserves and our reserves per share basis. Our long-term forecast right now, at $80, we look closer to 10% growth as it sits today. At $60, closer to 6% growth. The key is to make sure we pay the dividend. We have free cash flow to do what we need to do and take advantage of opportunities that present themselves, just like we did in 2020 at $45 oil, and 21 when oil was still working its way up, but was still in the 50s and it's slowly working its way into the low $60 WTI range. So this slide's quite old, and we're saying 23, $80 WTI in the top right corner of the blue square, 75 in 24, and 70 in 25, and it's generally up above outside of 23, probably $5+ in 24 and 25 right now, the strip pricing. So again, it would provide with our growth potential, again, continued growth in funds flow. And as you can see in the top or in the bottom right, you would get a buildup of working capital, positive debt, upwards towards $70 million in 25 in the green column there. And in reality, we've demonstrated our forecasts show that we've got the growth. We've got the growth per share. We're highly efficient on our capital spending. When you take a look at the top right corner, we have a $55 scenario all the way to the end of 25. We have a $75 and a $95 scenario. The purple's our capital spending. The orange is our base dividend, and the green is our free adjusted funds flow in each of those categories. So again, I would say at the minimum, you're at $75, and it shows significant free adjusted funds flow, which can be returned to shareholders or used strategically to continue to do deals like we've done in the last, well, not in 22, but in 20 and 21. So here's our main area. This is the Cardium in Western Canada. The two fields are Pembina, which is the north field. The yellows are land in there, and the bottom arm is Williston Green. Again, 85% of our production is coming from the Cardium zone for our company basis. Really, it's a 2.5-hour drive from Calgary to get to the middle of those fields. This is old oil field in Alberta. The Pembina Cardium is the oldest, largest conventional light oil pool in Canada of, pushing, I think, 20 billion barrels of oil in place. Now, it was developed in the 50s and 60s, or founded in the 50s and 60s and developed through the 70s and 80s with vertical well technology, water flood put in place right away, keeping the pressures up, and ultimately being revived with horizontal multi-frac wells, which is what we're doing. And I think we're doing it very well. Williston Green's just a little bit later in development, but very similar type operation there. Key to us growing here is just from our reserve valley rate as a year end as our base declines. Year one is 26%, which gets quite a bit less in the second half of the year, where year two goes into 18%. And then of course we drill on top of that, which increases it to, typically in the 30s into the low 30s for a corporate decline. That's important because that's manageable. And that's how we're running our business, by not spending all of our capital to show growth for growth's sake. You can grow more, I guess, if you want, and if the services are there for you. But it's very obvious that's not what we're getting paid for. I mean, we've been told by Bay Street and Wall Street, they want to see return of capital back to the shareholders. They want to see return on the capital employed. And that's not what this industry was doing for years. If when we used to spend, and I've been there and done that, every ounce of our cash flow to show growth, you'd have 40-45% decline, and that's all great at $80 plus, $90 oil, and $5 gas, $4 gas. But as soon as gas and oil drop to 60 and 2 or 3, you don't have enough cash flow to stay flat. This is a great way to run our business, to show consistent growth and to continually pay back to the shareholders while we wait for things to turn. So Williston Green, this is where we purchased Prairie Storm Energy Corp in, when did we do that? It closed November 30th of 2021. It doubled our land position in yellow. It just about doubled our drilling inventory here. We've taken this from 1,800 barrels, BOEs a day, to roughly 4,000 BOEs a day since then. It was highly accretive on all of our metrics. This is where we have lots of good control of infrastructure. It's a little higher oil weighting than some of the areas in Pembina. So we've been focused on drilling here this year. And we also upgraded to natural gas facilities in this area. The first was done in April, and the second one is actually ongoing as I'm doing this presentation right now. And should be online, the new facility, hopefully here in the next few days. Pembina Cardium. So we're drilling a few wells up in this area here. It tends to be a little bit oilier. In that blue box, that's the acquisition we did back in 2020, which completely changed our company. Very strategic acquisition, 100% asset of those two areas, 0 horizontal wells drilled in them. We've taken it from 300 barrels to as high as 4,000 barrels. It's currently in the low 3s, as we haven't drilled as much there in the last year and a half. But how good was this acquisition? 300 barrels a day we purchased it for, closed end of October in 2021 for 1.9 million. WTI, when we started looking at this acquisition, was $40 US. It worked its way to 45 or so when we closed. We got our lenders to lend us 1.9 million for this acquisition in a very tough lending environment. Didn't have to go to the market. If we could have actually went to the market at that time for equity, but we didn't dilute our shareholders. We started drilling in January of 2021. The first 3 wells came on at the end of March. That came on the same time we finished building a brand new battery oil facility to clean the oil from water and allow it to be sold into the pipelines. We drilled another 3 wells starting at the end of June, came on the end of July of 21. We paid for that acquisition 6 wells and a full facility, around 12.3 or $4 million by September of 2021. And in fact, the net operating income out of this little acquisition in 21 was it was $22 million. And then in 22, it was $77 million. These are the things we tend to do when we find an acquisition we like. We create value on them very quickly and very smartly with our acquisition strategy. I'm not going to spend a lot of time here. I'll just focus on, these are our type curves. And again, the Williston Green, or the Williston Green, the Cardium is such an old established play with great geological mapping in it. And it's just a low risk return play in Western Canada. But we're currently drilling these 1.5 mile horizontal wells in Williston Green. So 3.4 million to drill, complete, equip, tie in. Gives us about 310,000 barrels of oil equivalent reserves. Over the first 90 days of production, IP90 or 3 months, we get about 325 barrels and about 200 over the first year. So at $80 WTI, we pay out in 0.6 of a year. So just over half a year. Just very, very strong locations. And the rest of our locations in these areas are very similar to that. So our forecast, our 2023 forecast. So when we came out with this in January, WTI for the year was about $80. I think we did just under 74 in the first half of the year. We just updated all the guidance here at the end of when we announced our second quarter in August. And at that time, we had WTI in this forecast from $80 from August till the end of the year. And obviously it's quite higher than that. It's probably in August was in the high 80s, and we're probably in September in around $90 WTI. But at the $80 forecast, we're going to do over our production range 103 to 108 million in funds flow. If you actually take the H2 annualized funds flow of $80 and annualize that second half of the year, you're closer to 118 to 130. Remember, 130 was our funds flow in 2022. So again, pretty strong second half of the year. The one thing I'll comment on is every $5 a barrel WTI increase is about 5 million in funds flow. So very good looking second half of the year happening here for us. Capital program, will be around $80 million. Without the extra pricing due to WTI, we'll do free adjusted funds flow of 23 to 33 million, paying a dividend of around $16 million. Yield in the low, probably in the low teens as a percentage, 10 to 13%. Now, again, with that extra funds flow, you will see those yields increase into the higher teens and starting to push 20%. And again, a solid balance sheet. The EBITDA again 0.2 to 0.3 times. Like I say, we can get through thick or thin with these type of numbers. Great place to be. Again, we put out our sustainability report at the beginning of August. The biggest thing we can do is reduce our greenhouse gas emissions on the environmental side. We've done it every year except for 2020. We're doing our part. Canada's doing our part. The industry's doing our part. We're one of the lowest environmental impact countries in the world. I mean, we should be a producer of choice for our products. Our social, our governance side, again, is at the top of the charts. I believe generally Norway and Canada are at the top of the world and leading in these three categories. But in the end, with people that have reported their greenhouse gas emissions, our light oil peers, when you look at kilograms of CO2 equivalent per BOE, so that's the bottom right corner. Since 20, we've been in the top two guys there. We've been number two pretty much since 2020 amongst what I would call our light oil type peer groups that actually report these type of things. Here's a great slide. I've shown this before, I believe, last time I was out into the Houston area with Dan's group there, but to bigger groups along the way. This is enterprise value to debt adjusted cash flow multiples, Canadian history. It's just been updated. The last one I used was only good till the end of 2022, but it's now been updated. And what are we saying here? We're basically saying that, we are trading at low multiples. If you take a look at the far left corner, the yellow is our junior producers. The blue is our intermediate producers. The black is Canadian large integrated producers. We're currently trading in that 3-4 times cash flow multiple ranges. I'll come back to this January 23 or into 23 here right away. But people say, oh, we've never traded that low. Well, guess what? We did trade that low way back in January of 2001. That's in that 3-4 times cash flow multiples. So what happens in history? The undershading, the green undershading is WTI. What's required for what I would say multiple expansions from these lows that we're at? What is required is for WTI to have consistency, less volatility, and for the investors to believe that it's going to be higher for longer. Even in the 2005 to 2009, when WTI was averaging over $60, we worked our way up to seeing up to 6 times cash flow multiples. Juniors, 5 times cash flow multiples. And then, of course, the financial crisis with the big peak all the way up to 140 ultimately sent us right back down to $40 within the early part of 2009. So let's go forward a few more years. Pretty much from 2010 to 2015, once you got through the back end of that financial crisis, you really saw the multiples start moving up in 10 and into 2011, where the intermediates were trading at 7 times, juniors at 6 times. The intermediates actually traded higher than the large caps and integrateds at that time. But again, we had 4 or 5 years of consistent oil price between $80 and $100 and belief that it was going to be there. And we saw that multiple expansion. This is huge, this multiple expansion. You start talking us having $1.50 a share, $2 a share of cash flow multiples in the right environment. You start seeing 4, 5, 6 times cash flow multiples. This is where you see torque in the industry. Then, of course, you started seeing all the issues with 15, 16, 17, Saudi and OPEC flooding the market there in 15 and 16. And you just saw multiples trend down into 2020. Now, finally, we're getting into this spot where 21 to 23, we're trading at $70 WTI or better. You started to see the separation, which is normal, where the large caps and integrateds in black have started increasing in cash flow multiples. They're getting up into the high 5s and 6s as an average. The intermediates and juniors were pretty close halfway into the year, but you're now starting to see a little bit of separation there, where the intermediates are trading a little bit higher, and the juniors haven't moved yet. But guess what? Over history, we always have moved, and it's starting to get there. And in many of these circumstances, it takes a year or better to believe that after an issue that's occurring that you're going to see consistency. Well, I mean, our big issue that slowed down things was June of last year when the U.S. Fed put 100 basis points hike on the rate, and they went from saying, it's transitional inflation to, we got an inflation problem. So that's put uncertainty that's still going today. So in a multi-year oil bull cycle, which I believe we're in the early stages of it, look out, we're going to see some great multiple expansion as we move forward here. But that's it. I mean, we've been executing on our strategy. We're paying a 7.5% yield, 7% yield, low debt. That yield's sustainable. We got lots of optionality to do disciplined, accretive acquisitions with minimal dilution, a track record of doing great acquisitions. With that, I'm going to leave it, and I'll put it over to Dan, and we can answer some questions.
Yeah. Oh, I love that last slide, by the way, because I've been preaching like crazy that this is the year of the big paradigm shift. And the paradigm shift is going from, we're all going to be driving EVs here pretty soon and we won't need oil. I think we're now at the realization that that's not going to happen, and we're going to need oil and gas for a long time. Fossil fuels are going to be the base of all of our energy for decades to come, I believe. So we're getting there. And I agree with you, Doug. I think we're at the very beginning of a bull market that should keep, your friend up there, Eric Nuttall, that we watch his podcast a lot, and he's saying WTI in the $85 to $105 range is probably going to fix. I'm looking right now at the screen, and WTI is back to 90 after the little dip it took yesterday. So we're back there. So I got a few questions here. Now, we'll remind everybody, if you have questions, just type them into the chat box. I got a few here that I came up with before we started this. But Doug, can you tell me, with WTI at 90, what Canadian price are you getting for your oil now? How does that equate in Canadian dollars? Because that's what I use in my forecast.
Yeah, I mean, that's a great question, right? And every company's a little different depending on where their transportation hub is. But you're exactly right. Like, I didn't say it, which I normally do, but we pay our people, our services in Canadian dollars. We sell our oil in US dollars. So as you said, the strengthening of the dollar, the US dollar, our dollar is now 73 cents to the US dollar. So we're getting a 36% premium to WTI.
So you're like at $120 a barrel?
We're pushing close to $120 a barrel. That's
okay,
exactly
good.
Right. Canadian is what we're making, which is a huge boon for us.
Oh, yeah. Yeah.
Just a huge boon.
What about I know natural gas and NGLs they've come up a little bit, right?
They've been pretty consistent through the summer. I think NGLs as a whole have creeped up a tiny little bit. A lot of times winter's better for natural gas liquids as propane costs, or propane's gets a bit better pricing. And then butane can be quite volatile on that front. But of course, your condensates and your pentanes equate to a WTI price. In fact, usually trade a little bit of a premium to WTI, where our oil trades at a $2 Canadian discount to West Texas Intermediate.
So in my forecast, I should just use a little bit higher for natural gas and NGLs, just a little bit higher than what you had in the second quarter.
Well, not in the third. Third will probably be similar, or maybe even a tiny bit lower. But it'll start coming up. I looked this morning, it's like 280 a GG, so it's about 310 an MCF right now is the strip pricing for winter here in Canada on AECO basis.
Okay. I did see a report yesterday. The U.S. we are exporting a lot of NGLs. There's high demand down in South America for U.S. NGLs. But anyway, so maybe that'll help get the NGL prices again. Okay, if oil prices stay near current prices, do you expect InPlay to expand your drilling program next year, or do you expect to increase dividends, or both, maybe?
You know what? Like, I don't foresee us doing any more than 10% growth ever. And as you get bigger, sometimes it's harder to do that. We've done extensive look at the companies out there today, and you're not getting paid for that exuberant overgrowth. There's nobody getting paid for that. And, it creates so much other issues, which I said, like, you show growth in certain areas and you have downtime, it affects you. But beyond that, it just increases your declines, which is, changes potentially the sustainability of your business as you move down. So I guess the easy answer for that is, for all intents and purposes, will increase our return to the shareholders will be the excess free funds flow beyond what we project for any type of growth will be.
Yeah, you've got a stock buyback program going on too, right?
Yeah.
Okay. Are you did you buy back much in the third quarter?
No, we're not. We haven't been hugely active on it.
Okay.
I mean, it's not it's more we're using it as a kind of a stop case for certain scenarios when we really think it's a ridiculous trade. I guess I just if we do some deals, we will use our pristine balance sheet, but we will want to issue some shares. And again, it's that's part of your strategy, like buying shares and then issuing shares. It becomes a bit of a tug of war and a push and pull game. So we'd rather be using our positioning to do some smart strategic acquisitions, which, again, our track record of them is spectacular.
Yeah,
Spectacular.
and you got a lot of running room, but I'll tell our listeners the biggest gains that I've ever made on any companies is when this scenario that InPlay just did. You make strategic acquisitions when the oil price is low. You get them at a very discounted price because you negotiated based on $40 or $50 oil, and then the price of oil and gas jumps. You have successful well results, and next thing you know, you paid off a great acquisition in less than 2 years, and you've added a whole bunch of running room, and that's exactly what they did. So, boy, the company's in great shape. I mean, so many of our companies that we follow, Doug, you look back, they're in so much better shape today on their balance sheets than they were pre-pandemic, and a lot of them, the stock prices are just now getting back to where they were in pre-pandemic, yet they're in so much better shape. And you're kind of in the same boat as that. Anyway.
Yeah, and I mean, even then, very few companies are still back to those numbers. Some are, but it's been a slow road back here.
Yeah,
that's for sure.
Yeah, as you point out on this slide, I mean, the big upside is if we start getting confidence in the oil price, if we can stop this volatility and keep the oil price in the $85 to $100 range, around in there, and people gain confidence in that, I just think the money's got to be rolling, and they're trading at ridiculous prices. So who knows? But have you where are you hedged now, and are you thinking about hedging any oil to lock in some of these prices?
So I mean, we're just hedged on gas. We've been hedged on gas through summer. I think close to 50% of our gas we made in dollar, just over $1 an MCF. For 50% of our gas pretty much all summer. A little bit of winter gas is hedged right now too. We haven't hedged any oil. I mean, I guess the two pieces there are, I mean, the best hedge against the best hedge is to have a clean balance sheet, and that's what we have. Again, it is hard to go too far out, Dan, because the backwardation is pretty big.
Yeah,
right?
pretty steep. Yeah, like pretty steep right now.
Even you're getting 80, it's gone up again, but say you're getting $89 on strip for the rest of this year. It's down to 80 next year already, right? It's down over 10% for the whole year, and then it's down to probably 75, 76 for 2025. So you're hedging quite a bit lower. And we have no. We believe it should be strong, and 70, it should be every year low, but 75 is probably more like it. So it's hard to go too far. I mean, with that said, like, when we did our deals, we did have to hedge. Like, the lenders are making you hedge. So at that time, we'll take a look at
that's what's good. It's really good about having a clean balance sheet. You're not forced to hedge by the debt holders.
You're not forced to hedge.
Yeah. And with people that are not up on the industry, that when you have the highest price at the front of the strip, that's actually a very bullish sign, because that means demand exceeds supply today. So you basically got the refiners in a bidding war with each other for physical supply, and that's what drives up the front of the strip. So when you look at the NYMEX strip, the NYMEX strip is not a forecast. It's a derivative that it gives you the ability to lock in a price, but it's not a forecast at all. It's just what it is. It's a derivative, but it's bullish when the strip is sitting in a backwardation like this, because it shows you. And I don't see, today, Doug, and you can comment on this, global demand for oil exceeds supply by quite a bit. And we're going to get reminded of this tomorrow when OPEC announces the results at our meeting tomorrow. I think they're going to remind everybody that the world is in a supply deficit right now, and they have no intention of filling that gap anytime soon. So Saudi Arabia is in control, buddy. Yeah,
well, they are, and I've been preaching that for a year now. Like, they got their hand on the throttle of the big old yacht, and I mean, they have Vision 2030, right? They've got a very highly leveraged social country. So they need probably $90+, which is, whatever, it's
Mhm.
Arab Light, which is close to Brent, which, gives you kind of a minimum of $85 WTI. But I mean, to add to what you're saying, there's two pieces to that. And I think the key is the forward-looking curve is after half a year or longer. It's very levered towards financial institutions and how they're bidding oil, trying to buy oil cheaper. Hopefully, they can sell it at a higher price. So it's not fundamental driven. The fundamentals of the price look more like $85 to $90 where we're trading today. But the financial markets are what generally are driving the backwardation. And then the other piece to that is with the price of oil at 85, 90 today, there's a lot of incentive to sell that oil now, sell every drop you can now and not store oil. Well, we're selling oil and we're reducing inventories in the world. So again,
that's what creates, that's why when you have the front of the curve high, it just extends the shortage because there's no benefit to putting it in storage. So you want to sell as much as you can right now. Yeah.
And we're drawing inventories while we're doing that. So the fundamental side still looks very strong. The financial side is there's a separation there.
Yeah. Hey, let me ask you this. You didn't mention the East Basin Duvernay shale play. I would think with today's oil price, that's got to be a valuable piece of acreage now. Do you have any plans to, take on a partner or something to drill some wells there, or is there a way to monetize that for us?
So I mean, we're looking back into that now and reevaluating what we want to do. I mean, that's one of the ideas that's out there is to look for some financial partners. It is doing quite well. We're looking at what the offset producers are doing. The net backs, where we're a $45 barrel day net backs today, the net backs in that area tend to be closer to $80. So very strong net backs. I mean, the problem is it's just very expensive, right?
They're expensive. They're much more expensive wells, right?
Yeah,
but don't they come on real? Are they kind of like Permian Basin? They come on real strong and high decline rates. Yeah.
It's a shale play, so
it's a shale play.
It's a shale play, so you are a little different decline profile. I think still the returns are still a little bit higher than what we have, but again, my belief is with the assembly line mentality, which we normally use, and technology, you can start, if you can bring that down 25%, it'll be on par, or could potentially at some point be better than there. So I mean, we're again evaluating that now. If things look good in 24, I would hope to be able to start doing something with that play.
Yeah, that'd be great. I mean, if you did some kind of third for quarter deal and brought somebody into, you contribute the acreage, they spend all the money to drill the wells, and you get a free quarter out of it. Those would be some damn nice wells at $90 oil, I would imagine. So anyway, you mentioned this about doing more M&A, some kind of bolt-on deals or something. Are you seeing opportunities in your area, your main areas of operation there?
Yeah, we are. But again, we don't need to stay in our own area. And in fact, there's reasons to potentially look at other core areas that can be developed on. But bottom line is, there's things across the board. You're still not seeing a ton of M&A activity. The volatility of price is, as it keeps shareholders kind of holding on to their cash and just staying off a little bit. It's the same as trying to get deals done. It's, we're at $90, but strips next year is 80. We can't run our math at $90. So there tends to be discrepancies between the buyers and the sellers. The other piece of the puzzle is most people don't have the debt issues that they had prior years. So that, again, another reason for them not to sell too quickly. But with that said, there are still there's private guys that have been around a long time, private equity backed firms who tend to have a certain lifespan. You're starting to see some of that come to the market. We did see some in the spring. I think the price of oil going down into the 60s in June. It's kind of dead. And see, again, that volatility hurts this stuff, right?
Yeah.
Again, consistency allows you a little bit more opportunity there. So you haven't seen much, but there's stuff again that is interesting. And again, getting the financing done is not simple. I firmly believe for the right deals, we have no problems doing that and doing it smartly and accretively. But again, getting debt and equity is still not a simple a simple process. And of course, that's a little more expensive than it used to be, but
Yeah.
we're also not using anywhere near the amount of it. When you put it down to $1 per BOE basis, we are still paying less on that $1 per BOE basis than we were when we were running 1.5 to 2 times debt ratios.
Yeah. Hey, let me ask you, the TMX pipeline, that's the Trans Mountain Express pipeline. Does that help you guys? Does that help you get to better markets?
Sure. I mean,
Yeah.
it's predominantly a heavy line, but I mean, any product moving in different ways opens it up. Opens it up for us. But on the light oil side, in general, like we haven't, like, you know, we used to see apportionment, so that's when they had pipelines. So we're not seeing any of that. And I mean, you're seeing it in our differentials, which have basically been hovering between $2 and $4 for what, 2 year and a half or better now. That's low. That's very low, and that's because you know, in all reality, the Western Canadian light oil basin hasn't grown very much. You can grow mediums, you can grow a little bit, you can grow heavies significantly in Canada, but it's mostly oil sands type activity, which again, that's not going to occur with governmental dialogue that the industry's done, because these are multi-billion-dollar projects.
Oh,
that,
yeah.
you know, that need all this money up front, and with so much uncertainty of pipelines, of, you know, rules and regulations, you're not going to see them. You're not going to see them.
We know the politicians are our worst enemy in this business, I'll tell you.
Yeah.
And I don't know if you've been following the situation down at Cushing. You know, their inventories are getting so low at Cushing. They're really starting to worry about having enough oil to, you know, supply the refineries that tap into Cushing now.
Oh yeah, no, I
Getting pretty low.
Yeah, and even then, now they're talking about the president there needing to potentially remove even more out of the SBR, so it'll be down to nothing at some point too.
Oh God,
sad.
Crazy. Yeah, somebody asked, tell us about your last company and how that was sold. What happened there, and how was that experience?
Yeah, so I mean, our company you know, was sold in 2012. We sold our natural gas. I actually announced it on January 2nd of 2012, right into a crazy warm spell in January. Natural gas was dropping. We sold all of that. We
And that was Vero Energy,
that
right?
was Vero Energy.
Okay.
Yeah. So we grew it from 600 barrels to peaked at 11,000 barrels. Sold pretty much all of our natural gas and liquids in January. Returned some capital to shareholders. We started at basically in the Cardium. We grew from 1,800 to 2,800 barrels a day. In November, we sold it to a company through it. They came public, bigger company, through an RTO. I mean, we sold to them for $3. They did a 5-for-1 rollback to $15, and then they sold at the beginning of 21 for $2.88 after that rollback, so less than 50 cents. And again, that wasn't a terrible company. The problem was, it tells you how bad the industry was from 15 through COVID into 21. But I mean, we took about 15 million of seed capital, and pretty much everybody got somewhere north. Well, at that point in time, we were somewhere north of 105 out. The key to that is we sold at, we believe, is a very smart time in 2012. If you kind of take a look at the cash flow multiples on that one slide, you know, you're in that 6-7 times range. So how do I see Vero or Vero InPlay? How do I see that? I see it somewhat similarly. I think we're in a multi-year bull cycle. I think once the industry once the industry gets into that and the investors believe in that, we start moving up from 2.5, 3 times to 5 times to 6 times. And then, you know, at that time, we do some smart deals. We do a few things. I'm hoping I have $2.50 cash flow per share. And I have strong free funds flow. Well, guess what? Intermediates are going to want to be able to do accretive deals. You know, if they're trading a multiple or 2 higher, they can do a little premium, but they can do these deals and they can show higher free cash flow, and they can get more free cash flow. So it's a positive deal for them. And, you know, in my view, it's that all that's going to happen in the next 2-3 years.
Yeah. Well, my price target on your stock is like $6 US. And I think that's just like 4 times operating cash flow. Canadian, then I converted back to US. So I think I mean, you got a clean balance sheet. You got years and years of running room and low risk wells that pay out in 6 or 8 months. And I mean, I just don't see to me, this thing's a double, like looking straight at us right here. How do you feel about that? I mean, obviously you've talked about it. You think multiple expansion, but I mean, I think this is and let's talk about this too. When you talk about PV10 value in Canadian reserves, let's discuss how the calculation of PV10 value on a Canadian company is different than a US company. Because we look backwards for where you guys look forward pricing, don't you?
Yeah, they tend to use some form of strip pricing for the first so many years, but then they do for inflation, they'll start inflating it. But they also inflate our costs as well. So you're just showing a normal inflation rate there. But yeah, I mean, our PDP reserves would be the same as the US. Again, we're trading at $3. That's at $3. I mean, again, your $6 US is bang on, right? Because I mean, I think our slide shows 720 or something for a total proved reserve. I mean, at about what is, so 720 is like at $1.80 funds flow share, that's 4 times multiple is $7. So it all, we're just trading at ultra low valuations, whether it's net asset value or always the one near term that people look at is
my feeling is there's absolutely no justification for any company to be trading below just the value of their PDP, because that basically what you're saying is the company's not a going concern. You're not going to drill any more new wells. All you're going to do is deplete out your current wells, and that's it. But then to me, if you're a going concern, which you guys are obviously, then proved reserves, P1 proved reserves, net present value discounted 10% is definitely a good stock price forecast, I think.
Yeah, there's no reason to believe that doesn't come back into play, right? And you got to remember, when you used to get in that 6, 7, 8 times multiples, like you traded off of some ratio of 2P reserves, proved plus probable.
Right. Yeah.
Because that's when you trade those high multiples, that's what the analysts had to use to try and give you a target above and beyond where you were already trading. And back then, you'll remember this quite well. I mean, analysts, they used to give shale players a big net asset value for their land value, right? Like big number on the land, because it was undeveloped and it was hard to understand the locations on it. So that was also used in their calculations. But today, in all reality, like a total proved number is taking your blowdown of proved developed producing reserves, and it's a probability of 90% happening from a third-party reserve evaluator to get you to that total proved number. So I mean, that's it's a fully external, and our guys are one of the best in Canada, competent reserve evaluators with strict rules,
right,
telling you that adding some undeveloped locations, there's a better than 90% chance that you're getting that value.
Yeah, and now the way I look at it, I think 2P reserves on these plays that are so well defined, they're proven. I mean, they're not unproven in an area with that much geological control. It's there. So I don't know. I would think you're going to get a big uptick in your proved reserves this year. So and then somebody asked, speaking about government interference, are you worried about any interference coming out of Ottawa?
I mean, there's always things going on there. I mean, we have a really strong new premier here in the province of Alberta, and the province of Saskatchewan's premier is similar. I mean, they're fighting for our rights. I mean, resource development is part of the province's mandate, not the federal government's mandate. So we got strong leadership in our provinces, or equivalent to probably to the governors, I guess, of a state in the U.S. But anyway, so things are okay on that front. Like, and I guess my best example is, they've got targets, they got goals. I mean, they say they don't want to move off, and they made campaign promises. Well, they've also went off of about 20 other campaign promises since they got elected. So,
Right.
I mean, again, it's ridiculous. I mean, one of the biggest ones is 2015 was gonna, get affordable homes and stuff. Well, in Canada, the homes have gone out of control and most people can't afford them, and young people won't be able to afford them forever. And it's basically causing them big grief in the polls. But I mean,
Mhm.
that was a campaign promise in 2015, and they've done nothing about it until now, when it's become such an issue that it's too late. It's going to take a lot of time. So that's just another one example. But I mean, a better example is the government was very, very inundated with people inside there. Or it has been, and maybe a little less now, of NGOs, right, of environmentalist groups, and they listen quite a bit to environmentalist groups. And environmentalist groups are like, carbon capture and sequestration is not an option. We just need to get rid of fossil fuels, right? And they were of that mandate. Well, guess what? They've changed their tune a little bit, right? They're starting to agree with it, that we can be, part of the solution is carbon capture and sequestration. And you got the big oil sand guys, of course, who are the biggest emitters here in Canada. These guys are putting lots of money into this. They're called the Pathways Group. Anybody can look on their website, and they're working with the governments to capture emissions from their plants and put it in the ground. And so again, the government has moved on that. I mean, it doesn't take much when you realize that 10 to 20% of your gross domestic product is from this industry. That maybe I got to be careful what we're doing here. I mean, the other piece of that puzzle is, these oil sand companies are now becoming taxable, so a big chunk of their tax revenue,
Right.
which they've got issues with, is starting to come from these companies, which it wasn't taxable because of all the billions of dollars they put in originally. But now that's all paid for, and they're starting to pay taxes. So, you just got to do some math once in a while and figure out that some of this isn't too good, right? I mean, we just saw the prime minister of the UK basically changing the 100% electric car mandate to 2035 to 2030. Pretty soon it'll be 2040, right? But I mean,
Yeah,
at least there's a little bit of realistic realizations coming in here that maybe that's a little aggressive.
Yeah, I'm telling you, Doug, the all those charts you see where the electric vehicles are going, sales are going through the roof. I just bought a new car for my wife, and we went in there, and she's got a Kia, and they've got two really good looking electric vehicles. But I asked the salesman, he said, "Yeah, people test drive them, but we're not selling them at all. They're not at all." Then they because the price for the similar size car, similar comfort car is $8,000 or $10,000 more for the electric vehicle, and you got to put that charging station in your garage or something. So they're not buying them, and they're just not going to sell like they think that they're going to sell. I don't believe that's just my. Now I've heard that in Vancouver, that's they're all over the place, but I think that has something to do with the makeup of the population up there. Hey, are you possibly a takeover target for some like intermediate companies that are in the 25,000-30,000 barrel a day that want to get a jump in their production? I mean, I would think you'd kind of be a target for them with your operating cash flow and your low balance sheet.
I mean, potentially at some point. I mean, potentially at some point we'll be a wannabe target. But I mean, the good thing is I mean, we easily control 40+% of the shares, and we get to do it when we want to do it. And again, I'm a firmly believer in the cycle. I'm a firm believer in the multiple expansion. And you know what? We've done it before, and this time we'll even do it better. So,
well, this chart up on the screen, I have been all year saying that this year reminded me so much of 2010. In 2010, our Sweet 16 was negative all the way through the first half of the year, and then it took off. And then the second half of the year, we gained 54% in the Sweet 16. And it was this paradigm shift that, hey, oil prices are going to be longer. We're back into a bull market for oil. And I think that when that sinks in, you got a significant upside here, because we've now passed our as of last Friday. Now I pulled back a little bit, but we were behind the S&P 500. Now we're higher return year to date than the S&P 500. And I think we're going to finish much higher than the S&P 500 on these upstream oil companies now. So I just getting a lot more interest, man. I'd say we picked up a lot more members in Europe and Asia in the last year because of what's happened over there, with the Russian thing and everything. They're now getting it. Hey, we're going to be using fossil fuels for a long time. And you got a lot more people interested in this sector now. So anyway,
it just feels like it's a timing and a thing and a
it's timing thing.
When to get in, right? But I mean, you look back after you look back in 09 or started after the financial crisis in 08, and you look at the beginning of 09 and the dip, WTI was down in the first quarter down to in the 30s, right? And you look at the multiples, like it took the better part of a year before the multiples started moving back. So until the uncertainty starts to disappear, it could take upwards of a year for that to happen. And I mean, that's to me started in June of 2022. So we're over a year right now. But again, the problem is, of course, as this is dragging on, where in the 08 financial crisis going into 2009 and 10, it ended pretty quickly, right? And then we had demand. So this one's just extending, right? Like, I mean, higher for longer. The bonds market is going nuts, right? Like,
The fear. I call it fear of the Fed equals fear of recession, and that's all they want to talk about. So,
I mean, the good thing is our industry sitting here. Like, there was a well-known financial portfolio chief investment officer of a company in Toronto, Canada, sizable fund, generalist fund. And he was here, I think, a week and a half ago. He was on our BNN, CNBC equivalent in Canada. He says, the best looking sector is oil and gas. And, we're taking our portfolio from 10 to 15%, right? That's just what we're doing, right? It's by far looks like the best. And again, if it wasn't for, I mean, right now, I think yesterday, the Canadian index TSX is now, after yesterday and today, is 1% below, or it's down 1% on the year. Right. And it's the only reason it's not down more now is because the oil industry has actually gotten better. The oil stocks have gotten better since, at the end of June. They've all pretty much, brought the index up and kept us even at 1% for the year. Right. The techs have dropped and our banks, everything has dropped as well. Telecom, everything, they've all went down, and the oil industry looks like the best industry here.
Yeah, well, it is. And it's because you can go, it's not like these mining companies that take 10 years to develop a mine. You go out there and you start drilling these wells, get them completed. Next thing you know, you got really strong cash flow right out of the bed. And the fact that these wells these horizontal wells come on so strong, they were complaining about that with these shale. Oh, you're just burning up capital on these wells. I'm telling you, those horizontal wells, they pay out so rapidly. Like when you say your wells pay out in 6 or 8 months, when I was at Hess, if we had stuff pay out in 3 years, hell, our offshore stuff, it was lucky if it paid out in 5 or 6 years. You might have massive reserves, but from the time you first drill your discovery wells to the time you reach payout is, 5-6 year period. Well, man, this stuff pays out. It's incredible. Anyway, hey, buddy, great presentation. I think you guys are in good shape. We're definitely on board with you. Got a lot of members that own this stock. I see you're gonna be coming down here in November, right? End of November.
I believe, yeah, that's about the time.
Yeah, correct. I think we got you on the schedule for the last week in November lunch, and we're trying to get that going again. But anyway, hey, thanks a lot. We'll go ahead and end it here, and we've recorded this, so we're going to be sending out to this link to our global membership. So you should get a uptick a little bit in the amount of people looking at the company tomorrow. So anyway, thanks a lot, man.
Yeah, it's a pleasure. Chat soon, Dan.
All right, take it easy. You can end it now, Sabrina.